Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NEXTRACKER INC quarterly report. NEXTRACKER Inc. offers a range of businesses and services that cater to the solar industry. The company's product portfolio includes solar tracking solutions, NX Horizon XDR, NX Horizon Hail Pro, and NX Horizon Low Carbon Energy Yield Management System. TrueCapture Solar Tracker Foundation System, NX Anchor Advanced Installation Equipment, NX Trust Driver Monitoring and Control System, NX Navigator. These services are provided to various clients in the solar industry, including engineering, procurement, and construction firms, as well as solar project developers and owners. NEXTRACKER Inc. stock price skyrockets. A year of exceptional growth in a remarkable display of financial prowess. NEXTRACKER Inc. NXD has seen its stock price surge by an astonishing 155.54% in the past year. This meteoric rise can be attributed to several key factors that have collectively fueled investor confidence and driven up the company's valuation. Strong earnings reports, exceeding market expectations for revenue and adjusted earnings per share, have been a consistent theme throughout the year. The company's ability to consistently beat consensus estimates has instilled faith in its financial performance. Additionally, strategic developments such as new product launches, partnerships, and supply agreements have reinforced NEXTRACKER's leadership position in the solar technology sector. Analyst sentiment has also played a significant role in driving up the stock price. With an average recommendation of moderate buy from brokerages, analysts have shown continued confidence in NEXTRACKER's growth prospects. Price target increases from top firms like UBS Group and Goldman Sachs have further contributed to the stock's upward momentum. The combination of these factors has created a perfect storm that has propelled NEXTRACKER Inc.'s stock price to unprecedented heights. As the company continues to innovate and expand its presence in the solar industry, investors remain optimistic about its future prospects, solidifying its position as a leader in the sector. The primary drivers of revenue growth or decline can be categorized into two main areas: external factors and internal factors. External factors, such as government policies and regulations, economic conditions, market trends, and industry conditions, have a significant impact on revenue. Companies must adapt to these changes to remain competitive. Internal factors, including product development and innovation, research and development investment, intellectual property protection, operational efficiency, and strategic management, are also crucial for driving revenue growth. Effective management of these factors enables companies to stay ahead of the competition and capitalize on opportunities. In addition, risk management is essential in mitigating potential threats such as regulatory compliance issues, environmental, health and safety risks, cybersecurity threats, and financial management challenges. By proactively addressing these risks, companies can minimize their impact and maintain a stable revenue stream. Ultimately, successful companies must balance external and internal factors to achieve sustainable growth and success. Net income experienced a significant increase of 25.6% in 2025 compared to 2024, rising from $242,058 to $304,044. This growth is consistent across various time frames, including a 25% increase over both the 3-month and 6-month periods. However, profit margins tell a different story. While gross profit margin increased by 24%, operating income margin rose by 26%, indicating an improvement in profitability. Nevertheless, adjusted margins for gross, net income, and EBITDA all decreased, suggesting that despite higher revenues, the company's ability to retain earnings has diminished. The company is generating positive operating cash flow, as evident from the net cash provided by operating activities of $268,203 in 2025 and $274,627 in 2024. This indicates a consistent ability to generate sufficient cash from its core operations, positioning the company for long-term financial stability. The company's financial situation has undergone significant changes in recent months. Notably, the debt level has increased substantially between March and September of this year. However, a contrasting trend is observed in interest expenses, which have decreased by as much as 80% to $0.7 million and 72% from $6.9 million to $1.9 million. This reduction in interest expenses suggests that the company may be benefiting from lower borrowing costs or more favorable debt structures. The financial summary reveals mixed performance across various segments and regions. Notably, several international markets struggled due to competition from lower-cost providers. China, Thailand, and India were also negatively impacted by tariffs imposed under IEEPA, with India facing a particularly high penalty for importing Russian oil. On the other hand, international markets are actually mentioned as part of the company's strategy to continue growing revenues, indicating potential growth in this area. Management is optimistic about the company's outlook, citing opportunities for growth through market share expansion, new product development, and scaling sales headcount. However, they also acknowledge potential risks and challenges, including fluctuating industry growth and government incentives uncertainty around trade policies and tariffs volatility in steel prices, challenges from evolving laws and regulations related to AI open-source software vulnerabilities, and intellectual property infringement claims to mitigate these risks. The company plans to invest in employee base, IT, and relationships with customers and suppliers. Despite these challenges, management remains committed to expanding the business significantly within existing and new markets. The company has made several strategic moves through acquisitions and divestitures. On the acquisition front, it has purchased Ajo, SBI's foundations business, and Bentech. These deals are expected to enhance the company's capabilities and offerings. On the other hand, the company has divested Spin Distribution, merged with another entity, and engaged in spin transactions. While details of the latter are scarce, these moves suggest a strategic effort to streamline operations and focus on core activities. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. Inventory buildup is a concern due to increased production capacity, which may lead to stockpiling of goods. However, there is also a positive trend of decreasing inventory by $27.2 million as of September 27, 2024. Supply chain disruption is a more significant concern with multiple potential causes. Delays in construction projects and management issues could have a material adverse effect on the company. Suppliers' problems or disruptions in the supply chain may disrupt operations, while shortages of components or raw materials can affect timely delivery of products to customers. Ongoing trade disputes and unpredictable tariff policies also pose risks to procurement costs and access to necessary materials. Overall, these concerns highlight the need for careful management of inventory and supply chains to mitigate potential disruptions and ensure business continuity. That concludes the financial summary for NEXTRACKER INC. Feel free to comment below, and I will be happy to answer them when possible.